Nobody else talking about this? Silver CVOL just exploded to 115. The CME volatility index jumped 60% overnight. For context, normal range sits between 15 and 40. Anything above 100 is rare and extreme. Here's what makes this critical. It is now 10 points higher than when silver hit $120 just 3 weeks ago. The options market is pricing more explosive movement at 73 than it did at the all-time high. I don't explain what I do anymore. Either you verify sources or you don't. Either you read settlement documents or you trust headlines. Either you're here for data or you're here to argue. The ones who verify don't need convincing. The ones who don't won't last. The ones who belong here are already in the comments, adding sources I missed, fact-checking claims. Drop where you're re-watching from if you re one of them, that S. How I know who S. Actually paying attention. Silver Western Spot $73. Futures $73. Shanghai Spot $86. Futures $88. $13 premium holding between East and West, even as Western paper compresses. Gold Western Spot $4,880. Now sitting below $4,900. The divergence between physical and paper continues widening. While mainstream media declares the metals bull market finished after a 40% correction from highs, yesterday something broke in the broader market that directly explains why metals got hit so violently. U.S. equities saw massive two-way swings within hours that don't happen in healthy markets. S&P first dumped 1%, wiping $600 billion, then pumped back 1.1%, adding $650 billion. Nasdaq first dumped 1.34%, erasing $536 billion. Then pumped 1.43%, adding $540 billion back. That violent intraday whipsaw is the signature of forced deleveraging, when hedge funds face margin calls and have to liquidate whatever sells fastest. Regardless of underlying fundamentals or longer-term thesis, banks just tapped the Fed's repo window for $11 billion, $8 billion in treasuries, and $3 billion in mortgage-backed securities. This is the first time the repo window has been accessed since January 2nd, when $22.8 billion was drawn down during the historic silver squeeze. Something beyond metals positioning is triggering stress in the banking system right now. The ones who track Fed facilities daily know this signal doesn't appear during calm, orderly markets. It appears when liquidity pressure builds beneath the surface before becoming visible to mainstream observers. When gold, silver, and Nasdaq all crash simultaneously, the market stops caring about fundamentals and cares only about one thing: cash. This is the fingerprint of a liquidity crisis, not a normal correction. In healthy markets, these assets move differently. Stocks down typically means gold up as the traditional fear trade and safe haven flow. But in a liquidity crisis, everything gets sold at once to raise dollars. The US dollar index recess, acting as a wrecking ball, smashing all asset classes simultaneously. What we're witnessing is a deleveraging event where big players were long everything, using borrowed money. Something triggered selling in tech. And to cover those losses, they raided their own gold and silver vaults because those remain the most liquid positions they can exit quickly. Charles Kindleberger wrote, "Manias, Panics, and Crashes," documenting how financial crises follow predictable mechanical patterns through distinct phases: euphoria and expansion, peak confidence, profit-taking by insiders. Then panic as leverage unwinds and forced sellers dominate price action. The panic phase is characterized by indiscriminate selling where fundamentals become temporarily irrelevant as participants scramble for liquidity to meet margin calls. We're watching that textbook process play out in real time. Metals sell-off historically precedes equity sell-off. That's exactly what happened before the financial crisis. In liquidity stress, everything gets sold first, regardless of quality. Metals drop not because the underlying thesis breaks, but because margin calls don't discriminate between good assets and bad speculation. Now layer macro stress indicators that matter. Dollar strength, VIX rising, treasury yields falling simultaneously. This is one of the clearest stress combinations visible on charts. When the dollar resets, global liquidity tightens and capital moves toward safety. When VIX resets, institutions actively hedge and risk premium expands across markets. When yields fall at the same time, money rotates defensively into treasuries, and the bond market quietly prices economic slowdown. This exact combination has historically preceded equity drawdowns, commodity weakness, credit spread widening, and stress across global risk assets. This is a defensive macro regime forming, not speculation, but observable data. Tomorrow, FOMC minutes release. Thursday and Friday bring high-impact economic data drivers. If you're a short-term trader, The economic calendar tells you when manipulation is most likely to occur. The data itself has impact, but how big players use these catalysts as cover matters more than the numbers themselves. Expect volatility over the next 3 days, as these events provide liquidity windows for positioning. For the short-term traders who've requested technical coverage, this is tape reading education. Real tape reading, not the surface-level pattern recognition most courses sell you. Now open the silver daily chart and mark a horizontal line at the low of Wednesday, December 31, 2025. Then look at the rate on that low, which happened Friday, February 6, 2026. The body close of that February 6th candle closed above the December 31st low, confirming a swing failure pattern which is inherently bullish on lower time frames. You can see an inverse head and shoulders forming, though there's no displacement yet. Displacement is defined as a violent move, accompanied by high volume, that confers directional conviction. That February 6th candle is now key support. Currently, I'm watching the 72.6 to 70 range as support where price recently bounced. We may retrace lower, but if price wants to go higher, I don't want to see body closures below that level. A body close below that range signals weakness. Let me repeat, 72.6 to 70 is support, not a buy signal, but a tape reading framework. Price looks weak currently. But if it holds here and we get displacement, we could see 75, then 77. The bearish scenario, body closure below 72.6 to 70 support, means lower prices. Potentially 267 or below that February 6th wick. Now connect the technical to what the options market is screaming. Silver CVOL at 115 means traders expect massive moves within 30 days. High volatility doesn't predict direction up or down. It predicts turbulence and uncertainty. The market is pricing this extreme uncertainty with March 1st notice day approaching. High open interest, still not rolled. And delivery versus roll decisions creating potential positioning stress at the exchange level. A larger investor has been buying December gold call option spreads of 15,000 to 20,000. On COMEX, gold would have to triple from current levels by late 2026 for this trade to expire in the money. The position started building after gold hit 5,600 in late January. Even after gold fell below 5,000, this buyer continued accumulating open interest, now at roughly 11,000 contracts. Someone with significant capital is positioning for a violent move higher, despite current price weakness and negative sentiment. Here's where documented manipulation history becomes relevant to understanding current market structure. JP Morgan paid $920 million in September 2020. Case number 119-CR00438 for precious metals spoofing and market manipulation. Two of their traders, Michael Novak and Greg Smith, were sent to federal prison in 2023 for exactly these activities. This isn't conspiracy theory. It's settled federal case law with criminal convictions. The same institution paid massive fines, sent traders to prison, and yet the concentrated short positioning that would be illegal in any other commodity market continues appearing in CFTC data. When you understand this documented history, current price action during Shanghai closure makes more sense as tactical positioning rather than fundamental breakdown. Hyman Minsky wrote extensively about how financial instability grows during periods of apparent stability as leverage accumulates beneath the surface. The transition from stability to crisis happens not gradually, but suddenly. When forced selling begins and liquidity evaporates, the deleveraging comes first, creating artificial price dislocations. The opportunity comes after, when forced sellers exhaust and fundamentals reassert. Physical holders understand this dynamic. They're not trading volatility. They're positioned for the structural supply deficit that no amount of paper selling permanently overrides. Sentiment data shows emotion screaming it's over for silver. Parabolic moves don't consolidate politely. But the bigger structure remains bullish, according to analysts tracking long-term cycle patterns. Bull markets climb a wall of worry. What's interesting right now isn't the pullback. It's the sentiment shift to sudden fear and declarations that the entire move is finished. That's actually constructive. When you study market psychology, sentiment extremes often build the base for the next leg when everyone has been shaken out and only conviction holders remain. Commodities expert analysis projects silver climbing toward 120 to 180 this year, driven by dual forces. Massive industrial demand from solar, AI infrastructure, and electronics, combined with potential monetary role as central banks diversify reserves. The structural supply deficit entering year 5, with 200 million ounces annual shortfall, does UNT disappear because paper price corrects. Only 0.03% of global wealth has been allocated to silver in recent years. versus 0.06% in 2011. That underallocation relative to historical peaks during previous metals bull markets suggests significant room for capital rotation when the current deleveraging phase completes. CVOL at 115 pricing, extreme volatility above levels seen at 120. Banks tapping Fed repo 11 billion. First time since January 2nd, silver squeeze. Dollar plus VIX plus yields combination that historically precedes major sell-offs across asset classes. S&P intraday swing of 600 billion down, then 650 billion up showing forced liquidation mechanics. December gold, 20,000 calls now, 11,000 contracts despite falling prices. Shanghai $13 premium holding while Western paper sells. Technical swing failure, confirmed, February 6th, with current support at 72.6270. Sentiment at extreme fear, declaring bull finished. Silver allocation 0.03% of global wealth, drastically underrated. China closed, COMEX open through Friday, creating tactical window documented manipulation history through federal settlements and criminal convictions, showing this playbook has been used before. Bottom line, options market pricing, massive turbulence next 30 days. Banking system showing stress through repo facility. Technical support identified for traders. Sentiment washed out completely. 3 days of high-impact catalysts starting tomorrow. The question isn't whether volatility arrives, CVOL. Already told you it's coming. The question is whether you understand what deleveraging creates. Artificial dislocations divorced from fundamentals that correct violently when selling exhausts.